Well, happy Cinco de Mayo to you guys out there. So, my name is Dan Frio. I do the rate update every day to inform you guys and educate you on everything real estate, especially when it comes to the financing options. So, today we're going to talk about what the Federal Reserve said yesterday. Federal Chairman Powell, he hit it out of the ballpark. Basically, what he did is he just didn't spook the markets. So, that's the best thing I can say there. So, let's get over to the news. But what we're going to talk about right now is the Fed, employment, labor costs, and that's the news that we have for today and how that's affecting mortgage rates. So let's get to it. The first thing we want to look at is right here. Fed finally stuck to the script. So what happened yesterday, the Federal Reserve came out and said, okay, guys, we're going to raise the federal funds rate 0.5%. All right. But there was some rumblings in the background from other members of the Fed saying, well, we might, even contemplate raising the federal funds rate 0.75. Doesn't sound like a big to do, but it is. Okay. So the biggest turning point, what I want to show you right here is the biggest turning point was when Federal Chairman Powell asserted that 75 basis points wasn't even on the table. All right. So if this is new to you, let's dig into what's going on in the background. So basically, here's what's happening. The Federal Reserve, we know that there's inflation and it's running out of control. So the Federal Reserve is coming in trying to cool off the markets. So what are they going to do? That's the biggest question that everybody had or has. All right. So based on that, the Federal Reserve came out yesterday and said, okay, here's our game plan. All right, here's exactly what we're going to do. And the markets went, okay, at least we have guidance now, because some Fed members are saying this, some Fed members are saying that. Federal Chairman Powell came out and said exactly what they were doing. So that relieved the markets. Okay, so that's basically the backdrop behind this. So but what we don't want to talk about today is basically the only information on the economic calendar today is this. Initial jobless claims. Well, what is initial jobless claims? Well, if you go down here, let me scroll down, you can see right here. It's basically when somebody files for unemployment claims for the first time ever. So let me get my head out of the way so you can read this. So if somebody files unemployment claims for the first time ever, it's registered in this. Well, the number wasn't good. Okay, the last reading was 181,000 initial jobless claims. The expectations was for 182. It actually came in at 200. Well, the bad news doesn't stop there, but let's get to it. U.S. jobless claims jumped in the latest week, biggest amount since last July. Well, that's not the only thing that's kind of concerning here. Is also this. Worker output fell 7.5% in the first quarter, the biggest decline since 1947. So worker production fell 7.5%. You can see right there. At the same time, labor costs as a measure against productivity increased 11%. Well, let me surmise this for you or condense this together. But let's just read down through here, because I highlighted this just to inform and educate you guys on what's going on in the economy. This is also going to affect, if it's, it is affecting mortgage rates in real estate. It's also affecting your investments, your stocks, your bonds, and all the other pieces of the puzzle that you might have in your retirement plan or your personal finances. So worker production fell to start 2022 at the fastest pace in nearly 75 years, while the labor costs soared during the COVID. Non-farm production, a measure of output against hours worked, declined 7.5% from January through March, the biggest fall since the third quarter of 1947. And then you can see down here at the same time, unit labor costs soared, bringing the increase over the past quarter to 7.2%, the biggest gain since the third quarter of 1982. Why is this concerning? Well, let me explain it this way. We have more and more people filing for unemployment. Well, there's already I forget what the numbers were. There's over 11 million job openings. So there's all these openings and there's people working, but they're quitting. That's not a good job market. I know the unemployment as a percentage, the number comes out and it's like 3.5%. I don't like those numbers. I like these numbers. This is telling me how many people are working, how many people got laid off, how many people quit their jobs, and all the other stuff. So we're starting to see some major cracks in the employment section. And then also wages are going up. Thus, it's increasing, everything. And that's another piece of inflation. So why do we really dissect in these elements here? Well, again, the Federal Reserve has two primary mandates. One is price stability, that's AKA inflation. And the number two thing is maximum jobs or maximum employment. Well, this is starting to say that there's a lot of jobs out there and there's a lot of people quitting. And the production that's being done on the workers' behalf is down, but wages are up. Okay, that's not a good combination for anything. All right, so that was our focus for today. But the good news behind a lot of this is the Fed might start looking at this, as we saw yesterday. And the biggest things, when I did my yesterday video, I tried to put a thumbs up in the areas of the video where the Federal Reserve Chairman was speaking and really knocked it out of the ballpark. And one of those was exactly what they highlighted in this area. That the 75 basis points was off the table. Okay, so I'm all over the place, but if you follow me on a daily basis, you get it. So now why did you come here? Well, the main reason is mortgage rates. So let's see what's going on right now. The banks haven't reissued their rate sheets yet for today, but I'm expecting them to be better than where we closed last night in most areas, but going to get worse throughout the day. Why? Right here. This is what's happening to the mortgage-backed securities market. This right here, this is the bond that trades on Wall Street. That is the biggest determination of your mortgage rate. So how does this work? So basically when you get a mortgage, the yield or the rate on that mortgage is tied to something. Well, it's the mortgage-backed security, okay? This plus what we call LLPAs, and then plus profit margins for the bank or the lender. Okay, so, but this is the biggest component. So let me just explain it real quick to you. This is what's happening to the price of the mortgage-backed security bond. As the price in a bond goes down, the yield or the rate of return on that bond goes up. Well, because this is a mortgage bond, the yield would be the mortgage rate. So as you can see from the chart below, since the beginning of the year, all we've seen is down, 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 down. What does that mean? Rates are going up, 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 up. All right, so let's get over to where rates ended last night. We see right here. Okay, a lot of the banks didn't jump in and modify their rates last night because we saw a big spike in the mortgage-backed securities market. Yes, last night, basically at the end of close. So a lot of lenders just backed off and said, you know what, we'll adjust our rate sheets tomorrow. So the tough thing to figure out right now is where are they going to start? Because this is where they ended, but we had a huge rally in the MBS market. But here's where we are now. Let's refresh this and see if the bleeding continues. No, it's actually recovering a little bit. So we'll monitor this throughout the day. That's what I do to let you guys know or lock in our clients at the perfect time. So where are rates today? Well, where did they end last night? So let's go across this. This is a survey done by Mortgage News Daily. They do a great job. They survey lenders all over the country, and they get the rates back from all these lenders. They compile them together, and they put what the average is. So this is an average. This isn't a precise rate at any lender. It might be, but it is a combination of probably 100 or 200 lenders out there on where their rates are. Okay, so your rate might be a little bit higher than this, might be a little bit lower than this. And that's the only way to find out exactly what you qualify for is to get a hold of us. And I'm going to show you how to do that at the end of this video. So let's go across here. Where are our rates today? So we're going to start here over at the 30-year fixed. The 30-year fixed is coming in up 4 basis points from where we were yesterday, basically afternoon, coming in right now at 5.5%. It does come with a cost on average of 0.4%. So that's 0.4% of the loan amount. So that's how you do the math. You take the loan amount, times it by 0.4, hit the percent sign, hit equal, and that would be what the cost would be. Again, guys, this is just an average though. All right, so we go across the board. The 15-year fix is coming in flat at 4.88. It also is coming in with a cost. You go through the government programs, but they reference it as FHA, but we'll reference this as FHA, VA, and USDA. Those are government-sponsored or backed loans. Coming in at 5.12, a big move up at 0.12. We got the 30-year jumbos coming in at 4.71, up 1 basis points, and the 5/1 ARM coming in at 4.65, also up 3 basis points. So the trend right now, you see the chart right here, we are in uncharted territories. We haven't seen the rates this high in years and years and years and years and years. And then over here, the sentiment for the day is just teetering on neutral to negative. And why? Well, because yesterday we had a huge rally after the Federal Reserve Chairman spoke, and we're probably going to have some profit taking today. So how do you get a hold of me and my team? If you're in the process of a mortgage, hold on, I didn't do this yet. So here's what we do. We are a mortgage broker. Our job is to serve you guys to make sure you get the best program or the most accurate program for your loan. Okay. Did you go with an FHA when you might have been able to qualify for a conventional? Did you go FHA when you might have qualified for USDA or VA? There's reasons why one might be a better transaction than the latter for you guys. So we scan your loan over 130 different lenders all over the country to assure you guys the best program and the best rates. So how do you get a hold of us to just ask us questions and to kick the tires and see what we can do for you? Well, pretty simple. Go to therateupdate.com. Over at the top right, you're going to see right over here. You can give us a call at 844-775-5626. You can apply right online. Once you do this, it'll take about 10 or 15 minutes. Also, when you do this, it will actually tell you what documentation you need to upload to us so we can get your loan approved ASAP. Or if you're like, hey, I really got some questions and I'd love to do maybe a Zoom or a one-on-one talk with you guys, you can pick a meeting. Or the new button right here is the chat button. So if you're online and you're like, hey, I just got a quick question for you, you can do this. You'll actually get the transcripts after emailed to you. Pretty sweet system. So that's it for this morning. Hope you enjoy my video. If you do, all I ask you to do is give us a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. I'll be back this afternoon with some updates on the market. And then don't forget, tonight we're going to have a YouTube Live. It's 7 p.m. Central Standard Time. The topic today is how to choose a mortgage lender. So I hope you guys join us. Please, when you do, participate. That's what the whole thing is about. That's why we do it live, so I can answer any and all the questions that you have. So God bless, guys. Thank you so much. Happy Cinco de Mayo to you guys out there, and I will see you later this afternoon.